According to the Investment Company Institute, over 46 million American households hold IRAs, and a large portion of those assets are expected to be passed on in the next 10 or 20 years. Today, we're going to discuss how inherited IRAs really work and what you need to know to avoid tax traps, timeline mistakes, and penalties. Let's chop. Hi, I'm Dr. Preston Cherry, founder and CEO of Concurrent Wealth, where we help you align your life and money so you can live your wealth your way. And if you like what you see, hear, or feel on this show, hit that like button, subscribe, and leave us a comment. All right, so let's start talking about why this really matters. Here's what we see with a lot of our clients. They inherit a lot of money in IRAs and assume it's all theirs to spend tax-free. But in reality, it's a maze of rules, deadlines, and tax consequences. So we're going to help you with that and have a better understanding. So let's get into it. An inherited IRA isn't a bonus check, but it is a windfall. It's a structured account that comes with responsibilities stemming from a legacy. You can't contribute to it, but you must withdraw from it. And how and when you do impacts how much you keep. There are two main types. Traditional IRAs are pre-tax, where distributions are taxed when you withdraw. Yes, there are non-traditional IRAs too. We have a show about those. Be sure to go check it out. Then there are Roth IRAs, which are post-tax, where withdrawals are tax-free, but are still subject to a 10-year rule. Let's say you inherit a $300,000 IRA, for example. Sounds tax-free, right? But if you're not a spouse, you must empty it within 10 years. Miss that deadline and you could owe 25% penalty. This happens more often than you think, but it's avoidable. All right, so what's the rules? In 2019, the Secure Act introduced a 10-year rule. Non-spouse heirs must empty the IRA in 10 years. But in 2025, the IRS added more. Now you must also take required minimum distributions in years 1 through 9. Let's say you inherited a $600,000 traditional IRA in 2021. You plan to take it all in year 10. Not anymore. The IRS says you should have taken annual withdrawals starting in 2022, which was your required beginning date. That's a 25% penalty on each missed RMD. And yes, Roth IRAs must be emptied in 10 years if you're a non-spouse. Luckily, the new rule is not retroactive, but it's surely a good thing to know moving forward. Spouses have more options, roll it over into your own IRA or treat it as inherited. Non-spouse heirs and trusts, much stricter rules. Look, bottom line, inherited IRAs are not scratch-off tickets. You just can't cash them in when you want to. You have to have a plan, or Uncle Sam's going to write one for you, and his has one with penalties. All right, let's chop it up to see how you can avoid some mistakes. Spouses, if you're older, consider rolling it over into your own IRA and delaying RMDs. If you're younger, consider using inherited IRA rules for flexibility. Non-spouses, open the inherited IRA quickly, start RMDs. Match withdrawals to your own tax bracket and life needs. Inherited traditional IRA, consider partial Roth conversions before death to reduce taxes for heirs. Inherited Roth IRA, spread withdrawals out to avoid indirect costs like Medicare surcharges or student aid changes. As you can see, you just can't toss this money in a folder and label it retirement and forget about it. Inheritance without intentional planning becomes a burden, not a blessing. Common mistakes include missing RMDs, failing to update beneficiaries, or taking lump sums at high tax rates. All right, that's what I got for you today. If you want to take a deeper dive, head on over to the Concurrent website, check out our blog for more insights. And before I let you go, let me leave you with this. An inheritance isn't just about assets. It's about stewardship. Honor their legacy, build your life and wealth with intention and purpose. Be well, and we'll chop soon. Cheers.